Four of the largest tech companies in the world just reported earnings: Alphabet, Amazon, Microsoft, and Meta Platforms. All of them beat expectations. Revenue was strong, earnings were strong, fundamentals did not break, and yet the market reaction was anything but uniform. So the question is not whether these companies performed well. The question is, what exactly is the market pricing in right now? So let's go through the reports. When it comes to Alphabet, this is clearly the strongest report out of the four companies we're looking at today. We're talking about a meaningful beat on both the top and bottom line. Revenue came in slightly ahead of expectations, around a 2.7% upside surprise. But the real story is on earnings per share. EPS came in with a significant beat across the board. Consensus was around 2.63, while actual came in at 5.11. That's roughly a 94% upside surprise. So from a pure numbers perspective, this is a very strong print. Revenue also came in very strong, up 22% year over year, solid double-digit growth. Net income was up 81%. And diluted EPS increased by about 82%. So this is where the earnings surprise really comes from. It's not just a beat, it's a meaningful acceleration versus expectations. Operating margin also improved, coming in at 36.1%, compared to 33.9% a year ago. Looking at the breakdown, Google Services revenue grew 16%, which is still very solid for the core business. But the key highlight is Google Cloud. Cloud revenue was up 63% year over year. And more importantly, operating margin in that segment expanded significantly, up to 32.9% from 17.8% last year. So we're seeing both strong growth and improving profitability at the same time. On the other side, CapEx is also accelerating. It increased by 107% year over year and reached around $35 billion for the quarter. That's a significant step up in investment. As a result, free cash flow declined by about 47% year over year. But the important point is, it is still positive. So even with this level of spending, the company is still generating cash. And that's really why this is the strongest report of the group. Strong growth, expanding margins, and still healthy cash generation despite heavy investment. That combination explains why Alphabet is also the strongest stock reaction among all four companies. In fact, the stock is now trading near all-time highs after this report. Moving on to Amazon. This was also a beat on both revenue and earnings, but slightly less dramatic than Google. Revenue came in about 2.5% above expectations. Still solid, but not a massive surprise. The bigger story is on earnings per share. EPS came in at 2.78 versus expectations of 1.64. That's a 69% beat. Very strong. So again, on a headline level, this is a clear earnings beat across the board. Revenue was also strong, up around 15% on a constant currency basis. That's solid double-digit growth, especially for a company of this scale where top-line expansion usually slows down. Amazon continues to show that even at this size, it can still grow at a healthy pace. Operating income increased by about 30% year over year, and net income was up roughly 77%. There is also a one-time boost in net income, about $16.8 billion in pre-tax gains, coming from investments, including Anthropic. That's an important detail, but the broader point is still the same. Profitability is expanding strongly even without adjusting for it. The key driver again is AWS. Amazon Web Services revenue grew about 28% year over year, showing clear acceleration in cloud demand. Operating income in the segment also increased by around 26% on a constant currency basis. Very strong performance for the core profit engine of the company. Free cash flow, however, came down significantly, down about 95% year over year, mainly due to massive CapEx spending. But similar to other big tech names, the important point is not the decline itself, but the fact that cash flow is still positive despite this level of investment. There is also continued share dilution, although management is clearly focused on efficiently managing it over the long term through stock-based compensation discipline. So overall, this is a very strong report. But the key takeaway is the same as with Google. Acceleration in AWS is what investors really wanted to see. Moving on to Microsoft. This was another solid high-quality report, very consistent with what the company usually delivers. Revenue came in slightly ahead of expectations, up about 1.8%. On earnings per share, there was a stronger beat, around 5.2% above consensus, a modest beat, not as aggressive as we saw with Amazon or Google. Overall, this was a clean, stable print. Nothing flashy, but fundamentally solid. Revenue for Microsoft grew about 15% on a constant currency basis. That's a steady double-digit growth rate, very much in line with what investors expect from Microsoft at this stage. Net income increased by around 20%, which is a strong result, and diluted EPS was up about 21% year over year. So again, solid profitability growth across the board. Free cash flow came in at roughly $15.8 billion, down about 22%, mainly reflecting higher capital expenditures. CapEx itself remains elevated, higher than last year, though slightly lower than the previous 2 quarters, but still at a very high level overall. The key segment to watch is intelligent cloud. Within that, Azure and other cloud services grew about 39% year over year. That's a clear acceleration in growth, exactly what investors were looking for. So overall, another strong and consistent quarter from Microsoft. Nothing explosive, but everything points to continued strength in the core cloud business and stable execution. What's slightly interesting here is the market reaction. I'm a bit surprised to see the stock not really reacting positively to this kind of report. Given the consistency and strength of the underlying business, this kind of move could potentially create an opportunity, especially if you take a longer-term view on the company. Now we move to the most interesting one, Meta Platforms. This was also a beat across the board. Revenue came in about 1.4% above expectations. EPS beat was stronger, around 7.2%. So on the surface, this also looks like a very strong report. Revenue grew about 33% year over year. Net income was up around 61%, and EPS increased roughly 62%. However, EPS includes a one-time tax benefit. Without it, earnings per share would have been about $3.13 lower. Even so, overall performance remains very strong. On user metrics, family daily active people reached about 3.56 billion. That's up only around 4% year over year, and slightly down compared to the previous quarter. The company attributed this to external factors, including internet disruptions in Iran and restricted access to WhatsApp in Russia. Average price per ad also increased by about 12% year over year, which remains a key driver for revenue growth. The biggest focus, however, is capital expenditure. CapEx came in at roughly $19.8 billion for the quarter, already a very elevated level. And this is what's driving the market reaction. The company raised its 2026 forward CapEx guidance, lifting the entire range by $10 billion. So despite a very strong quarter, the stock sold off mainly due to one thing: higher long-term investment spending. But fundamentally, this is still a very strong report overall. If you just look at the numbers, this was a very strong earnings season. Alphabet, Amazon, Microsoft, and Meta Platforms all delivered solid beats in one form or another. But despite that, the market reaction wasn't uniform. Google moved higher, Amazon was roughly flat, while Microsoft and Meta traded down, and that's really the key point. This wasn't a story about earnings strength. It was a story about how the market is pricing future growth and the cost of that growth, especially in terms of massive ongoing investment. So the real question is no longer who beat or missed expectations, but what kind of growth the market is actually willing to pay for going forward. As it stands, the interesting part now is how these companies look from a positioning perspective rather than just earnings strength. Alphabet has arguably the strongest report, but the stock is already trading near all-time highs, and valuation is no longer particularly cheap. So at these levels, the upside looks more limited in the short term. A similar case can be made for Amazon: strong fundamentals, but the stock is also trading close to all-time highs, and valuation looks relatively full after the recent move. On the other hand, Microsoft and Meta Platforms are in a slightly different position. Microsoft saw a more muted reaction, and Meta sold off despite strong underlying results. That puts both names in a different valuation setup compared to Google and Amazon, especially Meta, which looks more interesting after the pullback, at least from a relative perspective. So overall, it's not really about which company had the best quarter, it's about where the market has already priced in strength, and where it hasn't. That's it for today's breakdown. If you enjoyed this kind of market-focused analysis, you can like the video and subscribe for more. Thanks for watching, and I'll see you in the next one.